Hello, and welcome to our market alert video for today, which is February 3rd, 2023. And this is going to be a longer than normal video because I want to go over with you why we think inflation is going to come down to under 4% by June, and why we think that is going to bode very well for where the market goes from here, plus some additional stuff to throw in just to make it more fun. So thanks for watching. Before we get going, I got to tell you that yes, this is a virtual background. The reason is because I'm in Colorado, and I'm in Colorado because we had a Alzheimer's fundraiser, and I was told that if we auctioned off a dinner with me and my wife, that we would raise a lot of money. Now, I thought, nobody wants to have dinner with me and my wife. Why would they want to do that? But they talked me into it. I got up in front of everybody. We had our big client event. We had close to 1,000 people there. And I announced that we're going to have the auction, and the winner will have dinner with my wife and me at the restaurant of their choice. Well, as it turns out, this one gentleman bought 10 $150 tickets, and he won. And he comes up to me and he goes, "Guess what? You said that the restaurant of my choice, right?" And I said, "Yes, I did." And he goes, "Well, the restaurant of my choice is in Breckenridge, Colorado." And I said, "Okay, I'm a man of my word. We'll have dinner in Breckenridge, Colorado." So that's why I'm here. I'm going to get some skiing in while I'm at it. So anyway, let's go into what we're about. So as I said, this video is going to be a little longer than normal. I want to start off by saying that, there's an old expression that says that when the news is at its worst, it means that the next news is going to be better. So think about that. And we've gotten just a tremendous amount of bad news, right? Everybody has been pounding us with how awful things are and how terrible the economy is and how bad inflation is. The Fed's going to destroy everything as we know it, all this terrible Armageddon stuff. But yet, job numbers today came out and they were stronger than expected, which means that companies are employing people, they're hiring people. Why would they be doing that if they saw their business going into the tank? They don't. And if the people have jobs, they spend. And if they spend, the economy is resilient. Now, the other part of it is that we think that inflation is going to come down. And I'm going to go into why we think that by June, inflation could be under 4%, even if we get bad news on the inflation front. So I'm going to keep you in suspense on that. But I want to give you a statistic that we saw on CNBC, which was very interesting. And that is that over the last 100 years, there have only been 5 times when you've had a negative year followed by a January where the market, the S&P 500 index, went up by more than 5%, okay? And this is the 6th time. So in 2022, the market was down. January was a tremendous month. The market went up by over 5%. So this is the 6th time. What happened in the other 5 times? Well, in all of the other 5 times, the market was up that year. And here's the attention getter, the average was 30%. 30%. So because of that, it gives us kind of an optimistic view of where we think the market's going to go this year. So I want to go over with you our investment committee at our firm. What we do is we try to isolate what is the reason why the market has gone down. And we believe that if you can isolate why it went down, then if that problem is going away, then the market should rebound after that. Now, in the past, there have been times when it's been difficult. For example, in 2011, we had China was having problems, Greece was about to go bankrupt, and we had the budget deficit ceiling debate between the Republicans and the Democrats, and they shut down the government. So we had 3 things at the same time. Which one was the one? We didn't know. Today, we look at it and we think it's kind of obvious. It's inflation. And if inflation is coming down, and I'm going to go over with you why we think inflation is going to come down over the next few months, mathematically, we think it's going to, then we think the market will respond favorably as the problem that caused the market to go down in the first place starts to alleviate. Okay, so what I'm going to do now is I am going to share my screen with you. So bear with me for just a moment as I do that. Hang on a second. And what I want to do here is I want to share with you how inflation is calculated. And basically, it's just a math problem. It's very easy to understand, I think. Okay, so first of all, I want to get your attention up here in the top left. This is the date, and what you can see here, it's by month. It's all the months from June of 2021 through December of last year. The CPI-U level, this is inflation, okay? The Consumer Price Index. The U basically means everything. They haven't taken out food and energy and all that. It's just everything. So the CPI-U level, and this is the monthly change. So this shows you the change between June and July. So this 271 went to 273. That was a 0.48% change, which is a 5.7 annualized rate of inflation. Okay, and then this is the year-on-year inflation compared to a year before. So let's go to what happened in December, this yellow highlighted area here. What you can see is that the CPI-U, the Consumer Price Index, went to 278.8. This was an increase from 277.95. That was a 0.31 increase. However, if you look at what it did in 2022, December a year later, it rose to 296. So from 278 to 296. But what is most important to understand is the month-to-month change. So a year ago, December, the month-to-month change was a plus 0.31. In the December of 22, it was a minus 0.31. So what they do is they drop last December off and they add this December on. They drop the 0.31 off and they add a minus 0.31. What does that do? It drops inflation from the 7.1 where it was down to 6.5. Okay, so let's do some projections. Let's look at January, and they haven't announced inflation yet, but let's just say, for sake of conversation, that the inflation rate suddenly spikes, and we find out that it jumped to a 7% annualized rate. Oh my gosh, terrible, terrible, terrible. Well, 7% annualized rate is 0.58% per month. Now, look at what it was a year ago, January. It was 0.84. 0.84 is dropping off, 0.58 is being added on, so therefore inflation goes down to 6.2% from last month's 6.5. So even if inflation were to spike to 7%, a massive increase over where we think it will be, inflation's been coming down. You can see all these months, it's been less than the 7. Suddenly the course changes. It goes to 7, we still get to 6.2. So let's do it again. Let's do it in February. So we have a month-to-month change, February 22 of 0.91. Inflation, once again, massive 7% increase. 0.58 is less than the 0.91. Inflation comes down to 5.8. Now, let's go all the way out to June. So here are April, May, and June of 2022. This is April, May, and June projected to be still this very high 7% annualized rate of inflation. It just does not go away. Well, that's a 0.58 in every month. Where it's red down here, it's where it's lower than it was up here. So what happens is that, yes, this one is higher than this one. That's why inflation goes from 5 to 5.1. But look what happened in May. That 0.58 at this very high 7% inflation rate, that 0.58 is less than 1.1. Inflation comes down to 4.5%. Again, in June, less than the 1.37, 3.7. So we think that mathematically, there's a very high likelihood, even under this kind of a very negative, pessimistic, terrible scenario of a 6 months of 7% inflation, that the inflation rate headline number will come down to 3.7. And the market, you know, whenever the headline inflation rate comes out and it says inflation was down to 5 or down below 4, how do you think the market's going to react to that news? Now, let's look at what the Fed is trying to do and what it would take for that to happen. They want to get it down to 2%. And there are a lot of people that are saying that in June of this year, the Fed will be successful. Okay. To make that happen, the inflation rate for the next 6 months needs to be at 3.6% annualized or less, which is a 0.3% per month, month-to-month change. And again, 0.3 is lower than that 0.84. 0.3 is lower than that 0.91. So the inflation rate, if it stayed at that, would get it down to 2%. We don't think this is a likelihood that it'll remain that low for that long, but it's possible. And if it does, then inflation would get down to the 2% the Fed is trying to get. How do you think the market would react to that news? So we think that that's a very positive, mathematically based outlook. Now, let's talk about what the problem is. What's the problem here? Here's the problem. The problem is, let's say the Fed is successful at keeping that inflation starts to go down and they hit their 2% target. So here it went all the way down, and here we are in June, and it's down to that 2%. Now what you can see is that if inflation stays at this 3.6% rate, then what happens is it starts to go up again. And what the Fed doesn't want is to get to that 2%, but then it starts going back up to the 4%. That would be bad, right? So they don't want that. So our view is that this, contrary to what a lot of people are saying, where they're going to start lowering interest rates in the second half of this year, we think the Fed is going to say, we don't want this to happen. We don't want it to start going back up again. And therefore, we think they're going to keep interest rates higher longer than perhaps the market is anticipating. Is that bad news? No, because if we have an economy where we have relatively low unemployment, we have inflation down around 2%, and interest rates at 4 or 5%, there have been many periods in the past where interest rates have been that high, and the market and the economy have chugged through it and done well. So that's not a bad scenario at all, in fact. So I hope you learned something new from all of that conversation with regard to inflation. So we have a lot of history on our side to tell us that 2023 could be a very good year. So we are optimistic about the future, but of course, only time will tell. So thank you for watching this video. Make sure you share this with as many people as you would like, friends and colleagues, etc. But more importantly, if you would like to visit with one of our retirement planners and to decide what you should be doing right now with your investments, your 401k, your retirement, we want to help you with that. We call your retirement your second childhood without parental supervision. We want you to go have fun and play with your grandchildren or whatever it is you want to do. We want you to have your money last as long as you do, and we want you to have financial peace of mind. So if we can help you to do that, we think we've done a noble thing. Our website, again, is rpoa.com, retirementplannersofamerica.com. Click on Meet with an Advisor. We'd love to meet you and part friends regardless of what happens. Okay, so thanks for watching this video, and we will talk soon.